JPMorgan just filed paperwork for a new tokenized fund on May 12. BlackRock filed for two of them 4 days earlier. Franklin Templeton already has one live. Circle launched the world's largest on May 7. If this sounds like a land grab, that's because it is, and the land they're grabbing is the infrastructure beneath every dollar you might ever hold in digital form. The market these banks are chasing has doubled in 6 months. Tokenized US Treasury funds hit $8 billion in May, up from $4 billion in November. By April, the broader category reached $14 billion. That growth isn't speculative. It's structural. In July of last year, the US passed the Genius Act, a law that requires stablecoin issuers to back every digital dollar with real reserves. 1-to-1. Those reserves have to sit in things like treasury bills or cash equivalents. Stablecoins are already a $260 billion market, heading toward $1 trillion by year-end. Every one of those digital dollars needs a home. JPMorgan, BlackRock, and their competitors are racing to build that home and collect rent on it forever. Here's what makes this different from a normal Wall Street product launch. Traditional money market funds settle in 1 or 2 business days. They close at 4 p.m. Eastern. If you need to move money on a Saturday, you wait until Monday. Tokenized funds live on blockchains like Ethereum. They trade 24 hours a day, 7 days a week. Settlement is instant. Not faster, instant. You can post a tokenized fund share as collateral at 3 in the morning and have it clear before breakfast. For institutions moving billions, that's not a convenience. It's a structural advantage so large that anyone still using the old rails will eventually be priced out. JPMorgan's new fund is called JLTXX. It's their second tokenized fund, the first one launched quietly last year under the ticker MONI. Both invest in US Treasuries and overnight repurchase agreements. The paperwork says JLTXX is specifically designed to meet the reserve requirements under the Genius Act. Translation: this fund is purpose-built to back stablecoins. Stablecoin issuers need somewhere safe to park the reserves backing USDC, USDT, and every other digital dollar. JPMorgan is offering them a government money market fund that never closes, settles instantly, and integrates directly with the blockchain systems those issuers already use. BlackRock is doing the same thing. Their BUIDL fund, launched earlier, already holds $2.3 billion. On May 8, they filed for 2 more funds. Circle, the company behind USDC, a $77 billion stablecoin, launched a fund called USYC that's now the largest tokenized money market fund in the world. The pattern is unmistakable. Every major financial institution is building the same infrastructure at the same time because they all see the same future, a world where most dollars move on blockchains, and the firms that control the reserve layer control the entire system. What does this mean for you? Right now, probably nothing. These are institutional products. You can't buy them in a brokerage account. But the infrastructure they're building will eventually underpin the apps you use to send money, the accounts where your paycheck lands, the way merchants settle payments. When you pay for coffee with a tap, that transaction still routes through Visa or MasterCard, clearing in batches overnight. In 5 years, it might clear instantly on-chain, backed by one of these tokenized funds, without you ever knowing the difference. The user experience stays the same. The rails underneath get replaced. The banks understand this. That's why they're moving so fast. BlackRock filed 4 days before JPMorgan. Circle filed a week before that. WisdomTree launched a 24/7 trading platform for tokenized mutual funds in February. This isn't experimentation anymore. It's a build-out. The tokenized treasury market doubled in 6 months because federal law now requires stablecoins to hold reserves, and those reserves need to go somewhere. The firms that capture that flow first will have a compounding advantage. Every stablecoin issuer that picks JPMorgan's fund over BlackRock's is a relationship that could last decades. Every $1 billion in reserves is $1 billion in assets under management, generating fees every single day. There's a deeper shift happening here. For 40 years, Wall Street worked on a T+2 settlement cycle. You buy a stock on Monday, it settles on Wednesday. Money market funds were the same. They were liquid, but not instant. Tokenization collapses that gap to zero. And when settlement becomes instant, liquidity stops being a buffer and starts being a weapon. The institutions that can move money in real time can arbitrage against the ones that can't. The gap between those two worlds will generate billions in profit until everyone is forced to upgrade. JPMorgan's filing is 2 pages of bureaucratic language about investment objectives and risk factors. But it represents a choice the bank made, that the future of money is on-chain, that the reserve layer for stablecoins is worth competing for, and that the firm that moves first will set the terms for everyone else. BlackRock made the same choice 4 days earlier. Circle made it a week before that. The race isn't over. It's just becoming obvious.